When a stock market investor liquidates or sells off his investment, he faces two issues before he reinvests his money into a new stock: the lost earning potential, and it's a waste of time and energy. Let's understand why. Let's say that you invest in the stock market. Over the past few months, the value of your investment in stock A increased, and you are now selling it to earn profits. You place your sell order on day 1. The stock gets debited from your demat account on day 2, and you receive your sell proceeds in your trading account on day 3. You can now either keep the money in your trading account until you find a new investment, or initiate a payout to your bank account. As a stock market investor, your first dilemma will be that this money will stay idle in your trading account, not earn any interest, and therefore not give you any returns. The second is that you will also have to spend a considerable amount of time and energy in transferring money between your trading account and your bank account. Is there one simple solution that can tackle both of these issues? Of course there is. Introducing liquid ETFs. A liquid ETF, or exchange-traded fund, as the name suggests, is a mutual fund product whose units are traded on the stock exchange. They invest in low-risk overnight securities like tri-party repo, repo and government securities, and other overnight securities. What are these, you ask? Well, repo refers to repurchase agreements in the form of short-term borrowings for dealers in government securities. The borrower sells the government securities to investors, usually on an overnight basis, and buys them back the following day. For the borrower selling the security and agreeing to repurchase it in the future, it is a repo. For the investor buying the security and agreeing to sell it in the future, it is a reverse repurchase agreement, or reverse repo. Tri-party repo means a repo contract where a third entity called a tri-party agent acts as an intermediary between the two parties to the repo to facilitate services like collateral selection, payment and settlement, custody and management during the life of the transaction. Liquid ETFs generally pay dividends on a daily basis, which is then reinvested into the fund. The aim of a liquid ETF is usually to provide an income commensurate with low risk, but at the same time providing a high level of liquidity. It is this high liquidity which makes liquid ETFs the perfect solution to your conundrum. This is how it all works. When you place your sell order on day 1, you can simultaneously buy liquid ETF units on the same day. On day 2, your stocks are debited from your demat account, and on day 3, instead of the sale proceeds from the stock being credited to your trading account, the liquid ETFs will be credited to your demat account, and you can start earning returns in the form of daily dividends. The advantages of liquid ETFs are: first, they help you earn more returns. Your money is always earning you interest rather than sitting idle in the trading account, or earning negligible to no returns in a savings account. Also, as soon as the settlement of the trade is cleared, liquid ETFs helps in delivering returns, thus avoiding days of lost returns. Second, liquid ETFs can be easily sold and thus are highly liquid, so you'll be able to invest when you find an attractive investment opportunity. You can buy and sell liquid ETFs both from the market as well as the issuing mutual fund house. Third, they save effort. Investors no longer need to make unnecessary transactions or move money between the trading account and the bank account. Liquid ETFs also help avoid the need to go through the trouble of waiting for checks to clear or making electronic transfers to a trading account. Fourth, liquid ETFs can be used for margin. While buying or selling stocks, it takes 3 days to complete a trade. To avoid the inconvenience of issuing checks or making electronic transactions each time, some traders keep some margin with their brokers. However, this margin money does not earn any returns. You could purchase liquid ETF units worth the margin you want to maintain and may earn returns till the time it is used to purchase stocks. Fifth, they give you tax-free returns. The dividend distribution tax that is applicable to these funds is deducted by the fund house, and since these aren't equity funds, securities transaction tax is not applicable. Dividends earned from your liquid ETF investments will be tax-free in your hands. The things you need to be careful about when buying liquid ETFs are as follows. Fractional units. Liquid ETFs give returns in terms of increase in units, which can add small fractions to existing holdings. Fractional units cannot be sold on the exchanges. However, these fractional units can be purchased by the issuing mutual fund house either directly or through stock exchange mutual fund platforms. Brokerage charges. Investing in liquid ETFs may incur brokerage charges, which varies from broker to broker. Most brokers may not charge any brokerage on the purchase of these products, thereby increasing their appeal for investors. It is still advisable for investors to confirm the brokerage amounts that they will be charged on trades in liquid ETF before making a purchase. Liquid ETFs are particularly suitable for large retail traders and investors, portfolio management service providers, futures and options brokers, and institutions which invest directly in equities. These liquid ETFs are also suited to the needs of high net worth individuals, as many times these investors may have funds lying idle either in their trading account or they may be maintaining margin money with their brokers on which no returns are earned. By parking funds in liquid ETFs, investors can earn returns on idle funds while also remaining liquid to benefit from attractive investment opportunities. Do more research on how liquid ETFs can make your trading more profitable and easier than earlier. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.